So let's go ahead and move over to our perspective, right? So in this class, we're going to focus on these three goals. We're going to hopefully teach you how to set a profit goal that funds your big life and pursue the activities to achieve it. We're going to help you estimate, save for, and pay taxes on time. And we're also going to help you be more fiscally savvy by reviewing your financials every month. Or as your business picks up even more often than that. Ideally, you should be looking at it every other month into it. And I'll show you where you can get those data and resources. And like I said, we're going to base this on the MREA economic model, which pretty much does three basic things. It helps you see where your money is coming from, which is known as the gross revenue. And it helps you see where your money is going through expenses. And ultimately, it's going to show you your net income or how much money is left. And in order to do that, we're going to go through a little scenario. And I want you guys to really think about why this one is an unsound financial habit that agents have. And unfortunately, most people fall into this category. And unsound financial health inhibits the opportunity to grow. It reduces their effectiveness. It creates unneeded stress and can be very expensive. Agents don't plan for their taxes usually. And so at the end of the year or at the start of the year, when the IRS comes and says, hey, you owe us this much, most agents are shocked. And the thing is, people don't know where their money is coming from. And because they don't know where the money is coming from, they also don't know what costs are critical to them. And when we're in situations like the current pandemic, where we really have to shift and minimize our expenses, if we don't know which expenses are critical, we're going to end up cutting expenses that will help us create more revenue. And the economic model is present in everyone's life. We all have an economic model, but the one that we're going to build today is going to be based on activities with projected outcomes attached to them. And I'll show you a spreadsheet that will help you identify those activities, like how much lead generation you should be focusing on, how many retention calls you should be doing, and what should be your conversion rate at the end of this class as well. And then this will lead you to a financial healthy business, which is going to be worry-free, makes you more money, and makes it work for you, and it also prepares you for challenging times like the ones we're experiencing today. So this is a hypothetical scenario where we have brand new agent Mary. Mary sold a property which represented a $9,000 commissions for her. After the market center split, she receives a check from the office for $5,760. Now, what do agents normally do? They take the $5,760 and they deposit it directly to their personal savings account. This is not a good idea. What really should be happening is Mary receives her $5,760 and 100% of that goes to her business account. She has a separate checkings account where she keeps her expenses there, where she keeps her income there, so that she can have that distinction and separation from her personal income or any other work that she does. And out of those $5,760, she pays her business expenses. We'll go over what is a business expense and what is a business cost. There are differences to this. You see how she earned $9,000, but then the market center paid her $5,760. That split is considered a business cost, is fixed, and is dependent entirely on your production. So if you don't produce, you don't have those costs. Expenses, on the other hand, are not tied to your product, to your production. And so that money should go towards paying for those expenses, like your board dues, your monthly dues, things like that. And we'll go into detail on those later on, right? So she took that $5,760 to pay her business expenses. And then out of that, she paid herself a salary of $4,032, which she then moved to her personal account. This is her salary. This is what she made. Out of those $4,000, she calculated that 40% should be her tax liability at the end of the year. This is dependent on you and your other sources of income. But she saved roughly 40% of that in a separate account, which is called the tax savings account, so that in the end of the year or every quarter, depending on your business status, she can pay that over to the IRS. And what's left over is essentially her net income, which is $2,419. And that is what she uses to fund her life. That is what she uses to pay her credit card. That is what she uses to pay household expenses, etc. So as you can see, there is a lot of movement of money there, which in the end of the day, it's going to set Mary up for success and not really struggle. So in other words, a financially sound business has one transaction, $9,000 commission. That commission becomes $5,760 net payment after costs. And then out of that, we calculated 40% went towards taxes. And then the rest went towards her net take-home pay, which was $2,419. So she has her expenses paid for, and she saved for her taxes, and she is free to live her life with that money that she has left over. So my first question for everyone is, that $9,000 commission check, would you consider it to be profit, or would you consider that to be revenue?
Revenue.
Revenue,
Yeah,
okay.
revenue. Yeah, I'd say revenue. Yeah.
Perfect. So Dylan, you were the first one who answered. Why would you say it's revenue? What do you think is the difference between revenue and profit?
Because profit is after expenses.
Correct. Exactly. Yep. So that $9,000, or what we call GCI, gross commission income, is just the revenue. Her profit in the end was the $2,419 because she saved for her taxes and she paid all the other expenses that are associated with her business. So now this is where we come to the point where we have to understand that our numbers tell a story, and we need to find out what those numbers tell our story. Like how do they tell our story? So how do you know if you're in a winning game if you don't know what the score is? You can't, right? How do you know if you're being successful in real estate if you don't know what your profit is? Most agents use a combination of these stats to judge their success in the business. So my question to you is, which ones do you think measure or tell the story of a healthy business for a real estate agent? We have gross commission income, which is revenue, like we talked about. We have volume, units, net income, money in the bank, multi-year trends report, and the language of real estate. What do you think are the top three that can help an agent see if they're being profitable and having a successful business?
Money in the bank.
All right, so we have money in the bank. What about the other two?
GCI.
GCI.
GCI, okay. And the third one?
It's closed.
Closed units?
Yeah.
All right, closed units. Any other guesses?
Sorry.
No worries. So actually, 99% of all the agents keep score with the top three on this list. So they keep score with GCI, with the volume, and with the units closed. I'm very proud that you guys actually chose net income and money in the bank, because not many people look into those. And really, when you look at the top 1% of our agents, they actually judge their business. Hold on 1 second. They actually judge their business by net income or profit, not by how many units they close, not by how much gross commission income they earn. They judge it by net income, not so much money in the bank, but mainly net income. Why? Because GCI, it's your revenue, like we talked about. You could make $9,000 out of selling a commission, but if you have to pay 25% referral out of that, or if you have to split it with another agent, at the end of the day, you might end up taking maybe only 10 or 15% of that. So can you really be successful and cover your expenses when you're just basing it off on GCI? You're not taking into consideration the other costs and expenses that come with your business. But when you actually look at the net income and profit, or your money in the bank at the end, that's when you're seeing that your actions are translating into money, into profit, into your salary. Any questions so far? All right, perfect. So let's just imagine the possibilities. What would you do with profit?
Oh my God,
What
what
is
a
your
beautiful
goal?
dog.
I missed it. I guess we have a
Okay.
dog somewhere.
Stella, you might want to mute yourself.
So what are some of your goals? Like, why did you guys join real estate, and what do you see yourself doing with that profit that you're going to make with us?
Live my life.
Live
Pay
your
my
life. Great.
bills, Pay my bills. Travel,
Perfect.
perhaps.
Awesome. Awesome. Those are all good. So what does profit mean to you? If you're talking about living your life, about travel, what is the main meaning of profit to you?
It's being able to pay your bills. You know, have a roof over your head, a car to drive.
Yeah, have a worry-free
food in your
life.
Stomach, you know,
Worry-free life. I like that.
yeah.
Absolutely. So ultimately, we want to fund our big life, like you guys said. We also want to grow our business and we want to invest in our future. This is some stuff that I heard all of you say, which is awesome. And lastly, we want to build a legacy, right? So we're going to go into the MREA model. And the MREA model pretty much says that you have income, which is your GCI, right? Your revenue. And out of that, you're going to calculate an average of 60% towards expenses. Like I said earlier, you have cost of sales. Costs of sales are fully dependent on your productivity. If you don't sell a home this year, your cost of sales are going to be 0. If you sell 100 homes this year, your cost of sales are going to be exponentially higher. And then you have your operating expenses, which are expenses that are always going to be there regardless of you producing or not, of you selling or not, right? So these are some of the expenses like the board dues, monthly income, and GMLS fees, super key, and all the others. And if you're sticking to the MREA model, out of that 100%, 40% should be left over as net income, as profit. And this is really where you're judging yourself on, am I having a successful, healthy business? Am I expending too much on my cost of sales? Am I expending too much on my operating expenses? And really look at what can drive your bottom line higher, right? So these percentages are not arbitrary. They actually come from a very lengthy study that Gary Keller and Keller Williams did with top producing agents throughout the nation. And these are the numbers that pretty much most of the very successful agents adhere to, right? And then based on this, a $10,000 commission check would look somewhat like this, right? So out of a $10,000 commission check that you're receiving, you should be expecting to net or profit $4,000. The idea is to drive 40% to the bottom line. This is a huge margin compared to other businesses. I mean, if you think about other business models, like restaurants or something like that, your profit doesn't tend to be 40%. It tends to be way less than that, maybe 10, 20%. At the market center level, we try to stick somewhat to this, but the reality is our margins are way smaller than a 40%. So a 40% margin, net margin for a real estate agent is actually very high compared to the industry out there. And like I was telling Cheryl originally, we're going to start from the end. We're going to start from profit and work ourselves down to figure out what we need to do to get there. So we're going to ask ourselves the following questions. How much money do I want in my bank account at the end of the year? And then from that, we're going to figure out how many homes do I need to sell to achieve that profit goal? And ultimately, we're going to ask ourselves, how can I minimize my expenses so that I can maximize my net income? So you see that the arrows kind of feeding into each other. It's all based on these 3 important questions. Slide 20, what slide is this? There we go. Okay, we go next. So the income from your real estate business in New Jersey, commission is typically 2.5% each side. Based on this, we can calculate our profit. Actually, in 2020, our commission was typically 2.3%. So really, you got to start showing your value so that you can earn that full 2.5%. And so out of that, we're going to calculate the cost of sales, and we're going to calculate the operating expenses. The cost of sales is the cost of making the sale. Commissions paid to the office, royalty fees, commission splits to any other employees or independent contractors involved, so like referral fees. If you are part of a team, maybe you have to make that split with that team as well. This is part of your cost of sale. And these are set costs entirely dependent on making the sale. If you don't make a sale, you don't have these costs. And then also operating expenses is the cost of running your business. So this is rent, this is your car, maybe if you're paying transaction coordinator services, insurance, outside of what we already provide you here at Keller Williams. So you don't have to worry about E&O. We cover that for you through the monthly dues. Any professional services, so like photographers, things like that. Stella, you raised your hand.
Yes, I had a quick question.
Yes.
So in regards to rent, so essentially my home is my office. How does that work? How much do I write down for the rent as the expense?
We'll
my
get
car,
to that
yeah.
certainly. We'll get to both the car and the rent expenses a little bit later in the presentation. But here, no worries. Thank you for the question. It's actually really relevant. But here, rent is more about maybe office desk fees. So like if you're renting a desk here in the office, you would categorize it there as rent.
Thank you.
No problem. But yeah, definitely we'll touch upon the car one because that's a big expense that most of us don't keep track of, but should be keeping track of for tax purposes. So other professional services, like I was saying, are marketing and advertisement, equipment and supplies, and education, like the CE credits that you have to renew every 2 years, any other classes that you're going to be taking for professional development within the real estate industry, right? Can I move forward to the next slide, or is anybody else writing? Okay, we're good, perfect. And then what's left over is your net income and profit, which you use to grow your business by maybe hiring an additional team member. You use it to invest in your future as well, maybe get a new CRM software or something like that. So we're going to do an activity right now. We're going to look at yourself and you're going to write your net profit goal. You're going to take that number and you're going to divide it by 60%. That will equal your gross profit goal. You will divide the gross profit goal by 40%, and that will equal your gross commission income. So that should be the number you should be targeting at the end of the year. And then you're going to divide your gross commission income by the average commission. And I'm going to tell you that our average commission in this office is 2.5% out of an average sell price of, just give me 1 second, I'll pull it up. Our average sell price is $544,000. All right, and once you get that, you're going to multiply your gross commission income by 30%, and that equals your anticipated cost of sale, which is like your split, your cap, and all that stuff. And then you're going to multiply your GCI by 30%, and that should equal your operating expense budget. So if we want to do a net profit goal of $250,000, this means that our gross profit goal should be 416, which means that our gross commission income should be $1 million. And that represents 139 transactions based on a average commission of 7,500. So if you're in a market where your average commission is much lower than what ours is, you would actually have to sell more. So that would mean that your anticipated cost would be $312,000. Which is for both expenses and cost of sale. So what are some ahas? What is something that you take away from this short activity and section that we just went through?
Work hard.
You gotta work hard. Okay. Anything else?
Well, the
Gotta
other,
sell a lot of homes.
go ahead.
Go ahead, Dylan.
Gotta sell a lot of homes.
You have to work on your conversion. You have to work on your lead transactions. But of course, most of you have another job, right? Like, or you're entirely focused on real estate.
No, I'm entirely focused on
Entirely
real estate.
focused on real estate.
Awesome. No, but that's great.
I had to take a part-time job, so there you go. I'm doing dual duty.
Absolutely. But that's great because it means that you have more time to invest in the business and more time to lead generate. And really get there. So, and that's the next step that we're going to look into. If we need to sell 15 transactions, if we need to do 15 transactions, how many calls do I need to make? How many appointments do I need to have? And what my retention rate should be? That's coming up. All right. Any other ahas? Anything positive that we take away from this?
This is really going to help me with my goal setting, like to finalize it. So thank you.
Perfect. All right. One aha that I really wanted to give you guys is, all right. Hi, Stacy. How are you?
Hi, sorry about that. I was picking up my daughter.
No worries. Welcome back. This is recorded, so you'll be able to see what we've done so far. So one of the ahas that I want you all to take away is that our checks do not go straight into our personal banks. They don't. Our checks will go into our business accounts so that we can from them separate the taxes. And ultimately, another aha that I really wanted to drive across the message to is try to stick to your budget. So if you want to make $80,000 at the end of the year, you know what your expenses are, what your maximum expenses should be. So don't go outside of those, right? That's a good way to really make sure that you're staying on track, right? You want to play green light, red light with your expenses. Look into what the return on investment are, and really consider if you want to keep those expenses, right? So we're moving forward to strengthening our business. Now that we know what our budget is, we're going to work on our financial team. Everybody should have the following people, or should know somebody within this realm, because you'll need them at some point in your real estate business. You're going to need an accountant / bookkeeper. For real estate agents, because you guys get 1099 NEC at the end of the year, it can get very tricky and messy because you have to do your own deductions and you have to prove those expenses. So it's something tough to do by yourself. So definitely have an accountant available to you. Most of the time you can be your own bookkeeper. We'll go over some of the apps that you could use for that. I personally like to use Mint. I know Google has a function for that, but I don't want to give all my data to Google more than what they already have. But you know, those are some things that you can look into. You also want your CPA tax advisor. You also want to be really good friends with a banker. So here at the office, we have connections with Atlantic Home Loans and we have Bond Street. Go ahead, Stella, you raised your hand.
Sorry, can the CPA tax advisor, is it recommended to be the accountant, or is that the same person? Like, I'm confused by that part.
So a CPA can be an accountant. A bookkeeper is most likely not a CPA. And the reason for that is because if you're an accountant and you want to work with taxes, you actually have to pass a test for the state of New Jersey, and you have to do additional work to be able to advise people on tax matters. So I'm an accountant, but I don't have a CPA certification. So most of your tax questions, I might say, go talk to your CPA, because I can't legally provide you that information. But yeah, most CPAs are accountants. Not all accountants are CPAs.
So I can hire somebody that can do both roles is just mainly my question.
Exactly,
That's
yeah.
available. And do we have a list of recommended like realtor-friendly CPA accountants or accountants?
Yep,
Okay, great.
we definitely do. And actually for February, we're trying to get one CPA who's very realtor friendly to come in and teach a little bit more of a detailed class on deductions and expenses for tax seasons. But ultimately, what I really wanted to say is number one can be yourself. You can be your own accountant. You can be your own bookkeeper. It's not that difficult. And I'll show you, we already created a kind of like a budget tracker that agents can use for that, for their business as well. And then you can become your own accountant and bookkeeper. So at the end of the day, you just really need a CPA to do your taxes. So like I said, banker, for mortgages, you need to be really good friends with an attorney. And we have a list for your preferred attorneys as well. Insurance agent, we have Carnegie Home and Auto that can help you with that. Financial planner, technically MCAs can help you out with that. So if you really want to come to me and say, hey, this is my budget, this is what I think I should be expending, I can look into those expenses, and maybe even Patty or Colleen can go into more in depth with, you know, what costs are critical and which costs are not. And then you need a coach, which you already do. You have Patty to do that as well. So those are your 7 members for your financial team. And right now, I want you all to look at your own business and really find out if you have a name for all of the above. So out of these 7 people, do you have somebody who can fill them already, or who do you need to look for out of these 7 people?
A CPA for me.
Good one. Anybody else?
Same thing, CPA.
Perfect. All right. And it's great because we're at that tax season place, right? So we all need a CPA at this moment. Great. So now we're going to look at our banking situation. How do we need to set ourselves up for a successful, healthy business? This is pretty much what we need, right? So we need a business checking. We need a business savings. Primarily business checking. You don't necessarily need a savings if you don't need to, if you want to simplify your stuff. I definitely recommend everybody to get a business card. Firstly, because from my understanding and from my experience on some business cards, they don't get reported to your personal credit score, which is interesting. But also you get points for your business, and then it really helps you keep track of your expenses. So like monthly dues, boards, advertisement, marketing, things like that. You can all just put it there. And at the end of the year, you can just come up with the statements and final transactions for that credit card, give them over to your CPA and say, hey, this was all my business expenses. So it really helps you differentiate and keep track of that. Personally, I actually have my personal credit card that I use for regular eating out and stuff like that. And I have my business card as well, which I use for business expenses to help me keep that separation between my personal and my business transactions. We need to have some kind of either account or method to save for our taxes. So like we saw earlier in the presentation, 40% of our salary, right? 40% of our salary should be saved over towards taxes. And just to make it easy, I rather keep them in a separate account. So I have 3 separate checkings account in 3 different banks, and I just move the money around them because at the end of the year, I know that whatever's in this bank is for this purpose and that bank is for that purpose. So it really helps. Other, which are optional, right? We should all have our personal checkings, our personal savings, personal credit card, and our investment savings as well. So the activity here is, how many do you have and what do you need to get? Anybody have all of these?
Joanne?
Yes.
You don't necessarily prefer that we have a business credit card that, like, you know, has a business name on it. I mean, for instance, I have just a regular credit card that I've always used for my business. So I used it for my last business I owned, and but it's got my personal name on it. So that's fine. I just don't put anything else on that, correct?
That's perfectly fine. That's fine. It's just the idea here is to only use it for business expenses.
Right, okay.
You know, don't mix it with, like, you know, Christmas shopping or things like that.
Right, I just wanted to clarify that, okay.
Certainly, yeah, no, that's a great question. Another really good information to have is if you're solely based in New Jersey, if your transactions are all New Jersey, your business checking should be at your personal name. I know a lot of people like to create LLCs and corporations and incs and different business agencies for their commission. Unfortunately, the state of New Jersey has a tax law that's very strict and prohibits any brokerages from paying commissions out to companies. So in New Jersey, when you sell a home in New Jersey, I have to pay you to a business checking account or a personal checking account that is your name. It cannot be, you know, Cheryl Ziracusa LLC. I cannot pay an LLC. I have to pay Cheryl Ziracusa directly. If you do business only in New York and entirely in New York, then, you know, consult with your CPA and your tax advisors on whether or not it makes sense for you to create an LLC, and then I can pay you directly to the LLC in that situation, or corporation or whatever. All right. Stella, you still have your hand raised. Do you have another question?
No, I'm good. I just
Okay.
got all right.
No worries. Perfect. So how many of you have all of these 5? Dylan, you have them? You're muted, Dylan.
I don't.
Sorry, I had a question about all car expenses I could put on my business credit card too, right? That's something that you would recommend?
Car,
Yeah,
like gas and things like that?
gas, insurance, all those things that would be on
It's
the business
tricky.
credit card.
It's tricky.
Okay.
And when we get to that section, you'll see why, because the IRS will let you deduct a certain percentage of your car payments based on how much you use it for your business. So if you have a car solely for real estate and you don't use it outside of real estate, then yeah, everything can go here because 100% of your expenses are for real estate. But if you have a
Right.
car that, you know, 75% of the time you use for real estate, but the other 25% is for personal stuff, then it becomes tricky because then you have to make that separation. And we'll talk about some apps where you can really distinguish those things. But, you know, if you have a car entirely and solely for the purpose of your business, then yeah, you can pay your leases by your business checkings and you can pay your gases with your credit card because 100% of that cost is a cost to you, is an expense to you. That makes sense?
Okay.
Perfect. Stella, you have your hand raised.
In that instance, that you cannot deduct the cents per mile. So if you're deducting the full cost of the car, then you can't be doing the mile tracker or anything. Just want to make sure that's correct, what I'm saying.
I'm sorry, you were kind of choppy. What was that?
You can't, I have an app called Stride where it
Yes.
tracks my mileage.
Yes.
And if, you can't deduct that if you're deducting the full car value. Is that correct?
Right. Yeah. So you have to kind of stick to one model. You either do 100% of your car expenses towards your business, or you're tracking the percentage that you're using it. But like I said, not many of us have a car only for real estate. We use the car for multiple things. So in that situation, it would be best to keep tracks by miles. And we'll talk about that a little further. But ultimately, just be very cautious because, like I said, credit cards are really great for your businesses because it helps you keep track of a lot of that. Not only are you earning points, but you're also keeping track of it. Just make sure that you're paying it off at the end of the month because those interest expenses can actually add up. And in your business model, you would have to add those interest expenses as an operating expense, not a cost, but an expense. That makes sense? So out of this section that we talked, yeah, go ahead.
Can you go back to the previous page? So you see number 1, 2 with business checking and savings and the credit cards. So what's the tax savings?
Yeah, so that's something that we talked about at the start of the class.
Okay.
And we looked at the fact that if you have a commission of $9,000 perhaps, right? Out of that, after you pay your splits to your brokerage, you get maybe $5,700.
Yeah.
Out of that, 40% should be your salary.
Yep.
And that 40% of your salary, you want to save at least, I think, what did we say, it was 30 or 40%? Which should go towards your tax savings because you guys are paid as a 1099 as an independent contractor. We don't withhold taxes for you. So ultimately that responsibility of paying your taxes is solely yours. So at the end of the month, at the end of the year, you don't want to be hit with a big tax bill from the IRS saying, hey, you owe us this much and you didn't plan for that, you didn't save for that, right? It's easy to say, okay, I owe you guys $10,000 in taxes because I saved for it. Other than, compared to, oh, I owe you $10,000. I don't even have that in my savings account. How do I pay you?
So Joanne, you're suggesting there be a separate account that they're keeping just for their taxes?
Yes. So
Okay.
like I said earlier, I think you were away, Patty, but I have 3 separate checkings account. It doesn't have to be, like that, but I have 3 separate checkings account. One of them is my personal, the other one is my business, and then my other one is my tax savings. Or you could just use your checkings as your business general operating expenses, and then your business savings could be just for that, for the taxes. It's really up to you. It's just as long as you have a method to really separate that amount at the end of the day.
Does it matter if it's in the same bank account or do you have separate banks?
It doesn't matter. You can, however it makes sense to you.
Okay, I'm sorry, I was writing, which I knew and not listen. Now I know why I didn't get A's in high school. Anyway. Just one last time, we need to have a personal account, a business savings account, which we can use for our taxes. And what was the third?
A business credit card or a credit card that you save
Oh,
your
good.
business.
So I'm cool then. Okay.
Yes, you're good.
All right.
Awesome. All right, so now let's talk about taxes. Again, I am not a CPA, so my information is based on what KW researched, and it's very limited. Additionally, another disclaimer is we're in COVID time, so tax laws are changing almost every single administration that comes in. But this is pretty much the basis of it. We all know that taxes are due on April 15th, right? Right?
Yeah.
Well, let me tell you, that's not true. So for business owners like you, your taxes are due pretty much quarterly.
Right.
So April 15th is just the final date for your fiscal year. But actually, these are the tax dates for business owners. January 1st to March 31st, the due date is April 15th. The second quarter is June 15th. The third quarter is September 15th. And the last quarter is the following January 15th. So for agents like yourselves in the future, when you're making a lot of money, when you're capping and when when your production levels are really high, you should really strive to pay your taxes every quarter. All right. And then at the end of the year is when you kind of do the final calculation. But yeah, so that's a big misconception. Generally for people who are paid salaried, yeah, April 15th is the day. But for business owners like yourselves, these are the due dates when you do the quarterly. So generally, taxes for sole proprietors, partners, LLCs, and corporations are due 4 times a year. If you're not one of these, then yeah, it will be April 15th. And there are very harsh penalties for people who do not pay their taxes in time. So definitely go get a CPA, go get a tax advisor as soon as you can to really determine if you qualify for these quarterly payments or if you're okay to just do it at the end of the year on April 15th. Right? So right now, I recommend all of you to schedule a date to find a CPA and meet with them to determine this. All right.
This is once we start getting commissions, right? Like,
Correct,
right
yeah.
now. Yeah, okay.
Yeah, if you haven't sold anything, there's really no taxes to pay. But you know, it's when you start generating income. And then also for the federal limit. So us as the brokerages, we're not required to report income to the IRS if you earn less than $600 in a year. If you earn more than $600, it has to be reported to the IRS, and then you get a 1099 NEC from us, which I don't think you guys receive because you're relatively new. But definitely for 2022, you should be receiving a 1099 NEC from me around this time. Usually around January, February is when you get those.
You don't have the record of all the houses I sold, Joanne?
I do have the record. So just email me for them.
Just checking.
Awesome. So just like Albert Einstein said, the hardest thing in the world is to understand income tax. And I definitely think he is right. So a quick calculation really to save and pay is to save and pay approximately 40% of your quarterly income, of your quarterly salary. So if you're making $5,000 after the splits, that doesn't mean you need to save 40% of that, right? Because you still have to take expenses away from that. So it would be 40% of those $5,000 would become your salary, and then 40% of your salary would be your taxes, if you're doing the deductions correctly. And hopefully that makes sense. So a good way to calculate your quarterly tax liability is to multiply your quarterly income by 40%, and then you should pretty much get an idea of how much you should owe the IRS at the end. Because, and like I said, we don't withhold your taxes, so it's really up to you to tax yourselves. And some of the different taxes that you need to look into and be aware of is income tax, self-employment tax, and the employment tax. I'll give you a brief description of what they are. So income tax is usually federal. All businesses must pay federal income tax annually. The tax you pay is based on what you reported on your 1040 IRS tax form. Income tax is also taxed by the state, and it's pretty much the same as a federal income tax. Some cities have income tax. I don't know if you were aware, but if you live in New York, you have to pay a Manhattan or New York City tax on top of the federal tax and the state tax. In New Jersey, that doesn't really apply in our area. So just be mindful of where you are, where you live in, and where you have to declare your taxes. And then depending on your business entity, like I said, LLC, Corp, or different things like that, and you expect to owe more than $1,000 in taxes, you may have to make estimated payments quarterly. So going back to those dates that we just saw earlier, if you think you're going to owe more than $1,000 in taxes to the IRS, you really should be sticking to that quarterly payment schedule. If you think you're going to owe less than that, then you can do it just at the end on April 15th. But again, consult your CPA. And then the self-employment tax is usually called a FICA or FICA, is pretty much Social Security, Medicare for individuals who work themselves and earn more than $400. This tax is based on your net business income. So your net business income, and you pay 15.3% of your net business income up to $132,000. Then it drops down to 2.9% for income over $132,000. This is based on 2019. Now I know that our previous administration changed the tax law, and we have a new one for 2020-2021 season. So just keep an eye out for that and consult your tax advisor. All right, and so the benefit at the end of the time when we're looking at this business model, the benefit of paying yourself a salary is that it really makes financial planning and tax estimating easier. Because if you know you're gonna, or if you know that your goal is to net $80,000 as your salary, then now you know how much your tax savings will be out of that, right? It would be 80,000. It would be 40% of those $80,000, as we saw earlier. Now let's get to the fun part. If the profit goal of Jim was $140,000, that means that every month he should be earning $11,667. And 40% of that should be $4,667. And that means that his net profit at the end of the month is going to be $7,000. That makes sense? Mm-hmm. Right? So pay yourself a salary. Now we're going to go over into the deductions. At the end of the tax preparation part, you're going to look at what expenses you can deduct from your business, and you're going to look at this together with your CPA and tax advisor. And let's just do a quick activity. which one of these do you think you can deduct for your business?
You can, accountant fees.
Okay, that's a good one. Next, and what about gas and automobile insurance?
I think it's only percentage, right? Just like if you have a home office, you can only claim like 25% of your mortgage or something.
Right. What about business cards?
That's a business expense,
Perfect. Cell phone?
both.
It's actually very similar to car. If you use it for a percentage, then yes. Clothing,
No,
good one. What about groceries?
no.
All right, good. So we don't have time to go through the whole thing. This is pretty much what it looks like. So these are the expenses that if you keep track of, you can deduct at the end of the year to decrease your tax liability. Again, the government will only tax you on your income, on your net income, on your net business income. So just because you made, let's say, $100,000 in revenue doesn't mean that they're going to tax you $100,000. They're going to tax you on whatever is left of that after you pay your business expenses. And these are some of those business expenses, right? So like we said, accountant fees, gas insurance, automobile, business cards, cell phones, computer services, health insurance, if you're using it through your business, which by the way, KW has open enrollment every November, and their fees are pretty reasonable. So if you ever need insurance through KW, you can just contact me and I can give you the information every November. That's when open enrollment is. Home utilities, meals, membership for professional organizations, so like your boards, your MLSs, travel to family reunion or mega camp, or other educational related events here within the real estate world, and website fees like command fees, or if you're hosting with GoDaddy, your real estate website, you can do it there as well. All right, so what are your ahas? What is something that you learned from this last section that we just went over?
Got to go get a business account at the bank.
That's a good one. Yeah, thank you, Cheryl. Any others?
Business cards. What else?
Yeah, those are all. Go ahead.
Credit cards.
Perfect. What about you, Leslie? What's your big aha?
I don't know. I mean, a mixture of everything, I guess. It's interesting to see what's accounted for and what's not as far as business versus personal. So
Got it.
Mhm.
Well, my ultimate ahas were deductions come from legitimate business expenses, right? It is important to keep track of what you spend in the course of conducting your business so that you can take advantage when it comes to tax time. Deductible business expenses must also conform to the rule of regularly and exclusively used in business. So that brings us back to the whole automobile discussion. If it's exclusively and regularly used for your business, you can deduct 100% of it. If it's not, then you have to calculate the percentage. And then remember that tax deductions are great because it means that you're only taxed on the portion of your income, not the whole revenue. But tax deduction doesn't mean free. So I don't know if you've seen any of those H&R Blocks or TurboTax ads where the guy's like, oh yeah, it's just a deduction. And then the accountant's like, well, who paid for it? I don't know if you've seen those ads, but this is pretty much what it is. So don't incur on expenses just because there's a deduction at the end. You're still paying for them. And ultimately, just keep in mind that there are caps to the amount an individual can deduct. So like I said, if you're doing business in New York or anywhere outside of New Jersey, then maybe consulting with a tax advisor to create an LLC or a corporation might be best for you because your limits are higher. That's when it comes to a time where you're creating a lot of production, right? And that's pretty much it. I think we have to end it now because it's already 3 p.m. But definitely, I would be happy to come in and continue the conversation. We have another few slides, but I want to take the last few minutes for any questions that you guys have.